Hey, videos. It's Dave Keller here with Market Misbehavior. Welcome to Chart This with Dave Keller, coming to you from a beautifully cool and comfortable Redmond, Washington. That intro, by the way, is the way my 8-year-old son Henry used to introduce his fake YouTube show that he had. Once he realized I had one, he created his own, and he would always start with "Hey, videos." Maybe that's my new intro going forward. Thanks for joining me every weekday after the close as we try to make sense of these markets using the best practices of technical analysis, what I call behavioral investing, which is really trying to understand how we are hardwired to make certain decisions in our portfolios, and how we can use the tools of technical analysis and behavioral finance to try to minimize their negative impact, focus on the message the markets are providing back to us in the form of price action. Kind of a risk off feel to the tape today, and it's been a little while since we've had one of those. Bearish engulfing pattern is a phrase you will hear me utter today on things like the S&P, which are not great. What that usually suggests is the next 1 to 3 bars most likely weaker rather than stronger. We'll look at the evidence together, see what that tells us maybe about the short-term environment on today, which has been, kind of a defensive move for markets overall. A lot of news-driven moves, by the way. Semiconductors down big. That is certainly not helping the major averages. Crude oil prices, energy stocks down as well. A couple quick announcements before we get on with our market recap. Number one, I so hope you've enjoyed the show. I appreciate your support and you watching wherever you're watching, on Facebook, on YouTube, on LinkedIn, on X. I appreciate it so much. I can't see the questions that you put in on whatever platform you're on. I'll do my best to grab a couple questions at the end of the live stream and take them. Anything we don't get to, we'll go into the mailbag. And Friday this week, we'll be doing an all mailbag show. By the way, I'm actually traveling to the Money Show in Orlando first thing tomorrow morning. So no show tomorrow on Wednesday because I'll be in the air flying down to Orlando. I did talk to the people at the Money Show, many of which are based in Sarasota, which got hit pretty hard with the hurricane. They assured me they're all doing okay. They assured me that the location in Orlando is good. And they also assured me they would really love if we had a great event, despite what has happened in Florida. So support the Money Show, support your speakers and all of that by coming to that event. I hope some of you are. Please make a point of saying hello. I'm actually going to be recording a couple episodes of my podcast called Market Misbehavior from the exhibition hall. I'll be doing a presentation in the exhibition hall about lessons learned, interviewing some top practitioners in recent years, and then a 2-hour masterclass on Saturday, which I'd encourage you to attend. You can go to moneyshow.com for more information. I actually think it's orlandomoneyshow.com to find more information. And I hope you can attend. Please say hello if you do. Also, I mentioned our new podcast, which is up and running. We've had 4 episodes so far. We're looking forward to a lot of great content to share with you, top conversations with top practitioners. If there are any people that you would like me to interview as part of our podcast series, drop a comment wherever you're at and let me know. Always looking for good ideas, and I look forward to sharing some good conversations with you. Also, happy birthday, Dad. It's my dad's birthday today. Always a good day. And honestly, my hero and mentor all around. All right, let's get to the market recap and look at how things have played out through the course of the day. I mentioned kind of a risk-off feel to the tape through the course of the day today. And, we opened weak and kind of continued weaker through the course of the day. It was kind of a pivotal moment, I would say around 9:30 Eastern time. We sort of opened not far from yesterday's close. We traded lower in the first hour. And a lot of times you'll have that initial move, and then you'll see buyers come in and all of a sudden put in the low for the day. That didn't happen. That initial run of selling kind of continued, and through the course of the day today, drifting lower. Last hour was kind of choppy. We sort of found a footing just about 5,800, but overall the damage had been done. That put the S&P down about 0.8% to 58.15. The Nasdaq Composite down about 1% to 18,316. The Dow down about 0.75%, about the same return for the S&P today. Mid caps and small caps, actually small caps were in the green for most of the day. Earlier in the day, small caps are actually up. So midday, right around lunchtime Eastern, it was small caps up, large caps down. Talk about a role reversal from what we've experienced here for quite some time. By the end of the day, though, large cap weakness kind of dragging everything else down. So you can see mid caps and small caps actually had a good morning session, but the afternoon all kind of rotated lower. And I would tell you that's actually pretty common, right? I was told a rising tide lifts all boats, and that was the way of describing that kind of the market trend drives a lot of the movements of smaller stocks in particular. And I get the logic. That doesn't always play out like that, but certainly I get the idea. Today was one of those days, right? The biggest names rotating lower. Other things kind of doing okay, but by the end, the weight of those large names kind of dragging everything down. So small caps did finish just barely in the green, 0.1% higher. Mid caps did finish slightly lower. The VIX moving higher, not quite a full VIX point, about 0.8 of one, but we're up to 20 and a half. So we're back above that 20 level. I sent out on social media earlier VIX over 20 is a high volatility, uncertain environment. VIX below 20 is a low volatility kind of bull phase. VIX right at 20 is make up your mind VIX. And that's kind of where we're at for today. At least the VIX pushing back above. Generally speaking, every day in an environment like this where it's unclear, every day where the VIX spends below 20 for me is additional check in the bullish column. And every day we spend a VIX over 20 is a not so bullish column. The fact that the S&P is at or near all-time highs, making a new all-time high yesterday, and the VIX at the level it is, right? The VIX is not down around like 15 or 16. It's up around 20, which is pretty high actually for the market making new all-time highs. We'll look at the chart of the VIX, talk a little bit more about the nuances there here in a little while. Interest rates overall moving lower today as bond prices rallied. Stocks were down, bonds were up. So interest rates actually came down as well. The 10-year yield finished today around 4.04. It was closed yesterday for the Columbus Day holiday, which stocks actually used to be closed as well. But bond markets are still closed on Monday of this week, open today. And you can see obviously yields came down through the course of the day today. Rates had been popping higher so far in October. So this is a bit of a reversal from the prevailing trend that we've experienced over the last couple of weeks. Bond prices moving a little bit higher. The TLT was up about 1.2%. Dollar index, no real change, to be honest with you, from yesterday's close. Commodities, a little bit mixed. The metal stock, precious metals in particular, had a decent day. Gold and silver prices were both up. Felt kind of like a safe haven move relative to the weakness that you saw in stocks and elsewhere in commodities. Crude oil prices were down pretty big. The USO, which is a crude oil ETF, finished today down about 4+%. It was down more around the open, but kind of moved steadily higher through the course of the day. And energy got dinged pretty good. Looking at crypto space, Bitcoin continuing to sort of thrive here as equities kind of went risk on going into end of last week into yesterday's session. Bitcoin kind of continued to push higher. So today you have one of those weird scenarios where stocks actually felt weaker. Cryptocurrency is actually feeling stronger. Bitcoin is right around 67,000, which is not quite to the previous highs in the low 70s, but certainly getting closer there and well off the 50s, which is where we were not too long ago. Ether price is just slightly below 2,600, and that's down slightly from yesterday. All right, looking at the 11 S&P sectors, it's defense over offense today pretty clearly, right? REITs were number one, up 1.3%. Real estate's a fairly defensive sector. Consumer staples, arguably as defensive, and that was up 0.2%. Utilities were third, up about 0.5%. You can see it was about a 50-50 split between sectors that were up or down today. So, that's actually unusual. We've had most sectors kind of moving higher recently. Energy was down the most, down 3.2% for the XLE. Technology was second from the bottom, down 2.1%. I mentioned the bearish news for semiconductors, kind of a regulatory risk that flared up. So down about 2%. We'll dig a little bit more into, I think I grabbed the semiconductor chart, but I forget. And then healthcare down 1.2%. Everything else was kind of hanging in there. So very much a defense over offense, and energy and technology, notably the bottom two sectors today. Looking at the Magnificent Seven and friends, you're going to see kind of a mixed bag here as well. We can see Apple, Alphabet, Tesla, Amazon all finishing higher. Apple, the best of this group, up about 1.1%. Nvidia, the big outlier here, down almost 5% today. Some of the other stocks in that space, we'll see in a moment, we're down quite a bit more than that. Netflix down 1%. That was the first Magnificent Seven stock. Is that true? First one to report coming up this week. Is that right? I actually have the charts right in front of me. Why don't I go look? Let's see. Netflix. Pretty sure. Yeah, I was going to say coming up on Thursday is Netflix earnings. So this will be the first one of the Magnificent Seven to report for this cycle. As a reminder, we're kind of in the meat of earnings season here starting on Friday of last week with banks, a lot more financials now today and through the course of this week into next week. And then it's kind of a bunch of everything else. There are other sectors certainly represented in terms of airlines, some other industrials, some healthcare, a bunch of other stuff. But next 3 weeks will be heavy earnings weeks. The interesting thing as we get ready for Netflix earnings is what happened with earnings today with NVIDIA. Is that true? That's not true. I'm thinking of United Healthcare, which is another one we'll talk about in a minute. Stock gap down, beat earnings, so they outperformed expectations. Now these were lower expectations, I think generally for a lot of companies. Expectations have been coming down, so they beat a lowered estimate. But the stock gapped lower because of lowered expectations going into next year, right? Sort of the forward-looking part of the earnings call was a much more bearish outlook for their business. And I think that's the risk for earnings season right now, is you get this sort of pattern where companies are talking about the impacts of interest rates, inflation, the dollar, whatever it is, events in the Middle East, whatever it's going to be, all of those things could weigh on stocks. That's the potential catalyst that's new and different here this week. All right, let's continue on looking at the chart review here. As a reminder, I will make time for a couple questions at the end. So questions that come up as we're going through, pop them in the chat wherever you're streaming this, and I'll get to as many as I can before we wrap the live stream. So here's the S&P 500. Actually, before I do that, I do want to show the market carpet. I meant to show that. Here we go, market carpet. So it's kind of a heat map looking at the major stocks, the S&P 500, but in a heat map form. And I love this kind of visualization. And as I mentioned on a couple other things, I use it for a couple different reasons. But the main way is, take a step back. What's sort of the overall, look to this quilt of stock returns today, and then get a little more granular and see what sort of opportunities you see in different areas of the heat map. First thing that comes to mind are NVIDIA and obviously the other semiconductors. A lot of technology names down quite a bit. I mentioned how some of the other semiconductors were down a lot worse. Here's Applied Materials down over 10% today. Here's Arista Networks down 5%. Intel, not too bad. KLAC down almost 15% today. So you can see some of these semiconductor names in particular getting dinged pretty good, but across, this isn't just semiconductors, it's other areas of technology as well, down pretty good today. And so you can see that cluster of red in the upper left corner. The second thing I would say would be the red in energy, right? Most energy stocks were down pretty good today. Exxon and Chevron, the two biggest names, down about 2.5% to 3%, but most names in that space down pretty good. We've talked about how energy is really essentially a play on crude oil prices. And if crude oil prices start to improve, you're going to see energy stocks be rewarded for that, because it's all about pricing and expectations for crude oil prices. Things getting dinged today means a little bit of negative outlook on crude oil prices. That's the play, and I think that's why events in the Middle East are so important right now. As much as that would inform our thinking on energy prices, that's what's going to inform our thinking on energy stocks. I mentioned United Healthcare. Elsewhere in healthcare, kind of a mixed bag, to be honest with you, but I'm noticing some of the pharmaceutical names like Merck, Pfizer actually having a decent up day. When you have a day like this, by the way, where the markets are rotating lower in the form of the major averages, when it feels kind of like everything's down, look for what's not down. Look for what actually thrived, right? Look in financials and things like Schwab, up 6% today, right? So see, these are some of the financial stocks reporting earnings and actually having a pretty decent update. PNC, Raymond James, both making new 52-week highs today. So there's strength out there. It's just not in technology, and it's not in growth, generally speaking, at least for today. Note the green in utilities, by the way, as well. It's funny, like I feel like if I had one thing on my screen besides just a chart of the S&P 500, if I want to go a layer down, I'd probably look at a visualization like this, because you can kind of think a lot about breadth conditions, leadership themes, small versus large, growth versus value, offense versus defense, and using different timeframes on this kind of visualization, pretty valuable. So I'd encourage you to check out. This is the one on stock charts. There are a number of platforms that have a heat map type of visualization. I'm a big fan of that, just because it gives you the starting point with which to dig deeper and start to focus in on different areas of the market. Just want to make sure I hit hit that one before we moved on. All right, let's look at a chart of the S&P 500. It's not good, and what I mean by not good is we have a bearish engulfing pattern. The next chart, I'll zoom in a little bit so you can see exactly what I mean, but it's a short-term distribution pattern, which is basically an up day followed by a down day. It suggests the next 1 to 3 bars are most likely weaker, and I'll get to a little more detail about that pattern and what it means in a moment. But just as a reminder, right, on a day like today where it feels like a big down day, certainly not the end of the world. I mean, yesterday we made a new all-time high, closing, above 58.50 for the first time. So let's not get too excited on one day's pullback. And as I mentioned, I think on yesterday's show, uptrends are often where you get some of the biggest down days. Same thing. Some of the biggest up days you'll ever see are in bear markets because they're these big snapback rallies after a sell-off. Here we're getting the opposite. We've had a big run higher and then a pullback to the downside. Remember what we've talked about in terms of what I call the line in the sand approach. The line in the sand approach is basically define the overall trend in the market and then have some exit strategy, which you clearly define as well. And what I mean is this: the trend in the market still, even with today, obviously, is still up, right? And I would say that trend is defined on the pattern of swing highs and swing lows. We're making higher highs over the last couple of months. We're making higher lows. That's an uptrend. I've drawn a trend line from the August and September lows as maybe an initial level to think about. We've talked about 56.50. I would say that swing low from earlier this month, kind of 56.70 to 5700, kind of an interesting level as well. So this is kind of that range that I'm eyeing. And the reason why I'm saying that is as long as we hold that on any pullback, I'm happy to label the pullback as just a brief pullback still within a primary uptrend. If we start to break below 56.50, that would mean we're undercutting the early October low, we're undercutting trendline support, we're undercutting the breakout level from July and August, we might be undercutting the 50-day moving average. If those kind of things don't hold, then I would have to say there's now a much higher likelihood that this is the beginning of a much bigger downtrend. That's when you need to start thinking about risk management, thinking about stops and making sure those are updated, thinking about how much downside you want to experience before you start really making changes to get more defensively positioned. If we do have a big pullback, remember the only way you can buy in on weakness and play the next leg higher is if you've unwound some of those positions in a position of strength, right? When the market's strong, if we can take some profits and unwind a little bit, and then you have capital allocate on a pullback, that's kind of how that's an ideal situation. So thinking about what level we would break that would tell me to get a little more defensive, I think is really important for me. Kind of that 56.50, 5700 range. That's kind of where I'm looking, which means we've got a little bit of room to have a day like this and still be comfortable calling this a bullish trend. Now, one of the things we experienced today, which tells me that pullback is kind of most likely happening here, is what's called a bearish engulfing pattern. This is a 2-bar candle pattern. You have an up candle and a down candle. And shout out, by the way, to any of you studying for the CMT exams, probably coming up in December. I often sponsor people going through their CMT charter process. It's a formal educational process for market professionals learning the technical analysis toolkit. You look at so many charts during that studying period. It's a bit overwhelming, but you learn a ton. And one of the things you study are basic candle patterns, and up to a lot more complicated than this. But this is a basic 2-bar pattern, an up day, a down day. It's called an engulfing pattern because the second day, the open to close range, what we call the real body of the candle, engulfs the first day's candle. So it happens after an uptrend. This usually means the next 1 to 3 bars are most likely lower. There is a built-in kind of stop to that signal, though. And this is something that Steve Nissen, who really popularized this methodology and brought it from Japan, introduced a lot of Western investors to this way of thinking. He explained to me a long time ago that the high of the 2-bar pattern is kind of the natural stop. So this is telling you we're most likely to go lower. But if we break above that first day's high, which is the high of the 2-bar pattern, that would negate that bearish engulfing pattern. So tomorrow, if we have a big rally and break above there, it says, nope, that's your stop, move on and reassess when we get another candle pattern. But for what it's worth, it's kind of a negative pattern for the next 1 to 3 bars. Now, what's interesting, I did talk about the Hindenburg moment. I've talked about this a couple times through the course of 2024. This is a major topping signal. It doesn't signal very often. As a matter of fact, in the last 5 years, we've only had 2 signals. The last one was at the end of 2021. The time before that was just before the COVID peak in February of 2020. It combines a series of trend and breadth indicators to look for consistent patterns that have existed at a lot of major market tops. And the key to this, which we've not been able to do, is you need to have multiple signals within 1 month, meaning you have to have multiple times where the indicator fires within 20 trading days. And we've had a couple of initial signals going back over time, but we've not had that confirmation of multiple signals that have fired within a month of one another. If it would do that, that would basically tell you high probability of a market top. And what we haven't had, by the way, one of the factors is new highs and new lows have to be at least 2.5% of the New York Stock Exchange listings. We've had plenty of new highs in the month of October. We have not had enough new lows, not enough stocks that have already broken down that are making new 52-week lows, which is a key piece of the puzzle, according to Jim Maeka, who created this indicator years and years ago. So for now, I have to consider it a non-signal. I'll continue to monitor this to see if we get a reinitiation of it. But for now, this indicator at least not firing a sell signal. The VIX, by the way, is sort of hovering around that 20 level, and it's been there a lot here in October. We did break above 20. 20 for me is kind of that correction kind of range. VIX below 15 is the market's probably doing nothing but going up. Don't even think about anything else. Just follow the trend higher is the general sense there. Between 15 and 20, we have a little bit of elevation in the volatility, but it's still a low volatility environment by my tracking, right? And a lot of just sort of brief drawdowns within an uptrend can happen there. VIX above 20, but below kind of 28, 29 is a corrective move. This is probably, we're already in a pullback phase. You need to start thinking about downside protection because the VIX spiking above 29 has usually been a very clear and consistent signal of a significant drawdown. Now, the last time we broke above that was in early August. The VIX actually registered one of its highest readings in history. The August low was not soon after that. It was actually right around that point, first week in August. The VIX spiked up into the 60s. We ended up finding a low just about 5,100. And from there, the markets move higher. So the way that the VIX has played out in August, September, October, I would have to tell you is pretty unusual. For me, usually a VIX spiking above 20 like this is what you normally find in a bearish trend. This is what normally happens when the market's in kind of a risk-off mode and you have elevated volatility, elevated uncertainty. This, to me, the way I would describe this, the caption for this chart would be the most hated bull market in history, ? That's probably what I would entitle the caption here, because the volatility tells you we're uncertain and uncomfortable, but the market keeps going higher, which means one of two things. There's uncertainty, but it's net positive, and people are still buying into the optimism, even though we're not feeling particularly good about it, or there's something artificial going on here. And either there's uncertainty that's not being reflected in the benchmarks for some reason. There's artificial buying, liquidity kind of things that are causing the market to artificially stay high, even though investors are getting nervous. Interesting, and it's hard to tell just from this one chart. I mean, my analysis of other sentiment indicators, which we talked about on Thursday's show of last week, if you missed it, we talked about a couple of survey reports and what they told us. They're not excessive yet, right? They're kind of bullish, but not overly bullish just yet. And maybe that tells you we still have upside to be had according to those sentiment readings. Bitcoin, by the way, nice pop higher. We are clearing that late September peak. Getting above the August peak as well. I think that's encouraging. Getting back above the 200-day in the last couple of days, I think has been a meaningful development as well. For me, it's all about getting above these previous highs. The weekly chart, you can tell how important of a base this is. This is now an 8-month base that we're in the middle of, I would argue, sort of this period here. I'm excited when we get out of that range. I do own Bitcoin and Ethereum for the record, full disclosure, but overall, I think in terms of the medium-term time frame, it's all about the overhead resistance at this particular moment. Defensive sectors, you can see a bit of a turn higher. You can see the defensive sectors were at the top of the list today. I mentioned like REITs, staples, having a pretty decent day. The relative strength is still okay in some places, particularly utilities, which have been one of the better places to be in 2024. I would say consumer staples and real estate have really been trending lower over the last 4 or 5 weeks. Any upturn in the relative strength of defensive sectors is usually a big red flag for me in terms of a bullish market that feels overextended and we start to rotate lower. Banks breaking out. This is probably the first big earnings headline we've experienced in 2024. They were up earlier in the day a little bit more. They did settle down as everything was kind of dragged down going into the close. But the KBE, which is the top half, the KRE, which is regional bank ETF in the bottom half. Both of these making a new 52-week high today. I like the strength in banks. My interview with Mike Livingston on Thursday of last week, we talked in particular about Singleton. Sorry, not Mark. Mike Singleton of Invictus Research. We talked on Thursday of last week for my podcast. He mentioned regional banks as an interesting way to play the interest rate environment. I thought his comments were really well informed. If you want to go back and review those. Final chart or two, and then I'll take a couple questions. I see some good ones coming in here. Cruise lines continuing to impress. We've got some earnings coming in on some of these names. And I would say overall, the trends have been quite strong. Carnival actually reported a couple weeks ago, and you can see the overall trend has been pretty positive. Royal Caribbean, Carnival, Norwegian, all rotating to the upside. Carnival in particular, this is breaking out of a pretty nice base. These are the highs from 03 and 04. A number of times we've kind of hit that $19 to $20 range, and it's been repelled. Finally, we've broken out of that range. I think that's sort of a nice, compelling breakout area of the market that shows some additional strength. To finish off here, and then I'll take a couple questions. AMD, the whole semiconductor space was down pretty good today. By the way, jumping to a question, what happened with semiconductors today? A couple things to think about. And someone else mentioned an earnings leak. I would say a big part of this was the regulatory impacts. There was news that with semiconductors, they would be limited in terms of the amount of semiconductors that they would be able to sell into non-US markets to minimize the chance of them ending up in the Chinese markets, I guess is how I would summarize what I read today. As a result, sort of looks like semiconductors all getting dinged as a result of that. To be honest with you, I think that is one of the biggest challenges for equity investors, particularly with some of these leading themes like AI, mega cap growth stocks, all the not AT&T, but all the different semiconductor manufacturers, AI plays, sort of the mega cap Magnificent Seven, the regulatory risk, right? And we saw that with Alphabet, where they got dinged when there was discussion about antitrust legislation or some attempt to break Alphabet into smaller pieces. That's the risk for some of these leading names that have gotten so big, driven by their business. This is when regulators love to start to make changes to whatever they were able to do to make a ton of money. All of a sudden starts to negatively impact things. Call that regulatory risk. That's one of the things you deal with when you're investing in individual equities. And I think it's hitting the semiconductor manufacturers. Yeah, you should. And I saw your follow-up question there. Yeah, you should probably dig in a little deeper. I can only summarize what I've read from a couple different sources, but it looked like, limiting semiconductor companies from where they're able to sell, how much they're able to sell outside the U.S. Let's see. Yeah, credit spreads. Really good question. We'll finish off here with a couple questions. Thanks, guys, so much for peppering questions in. Any of the questions I don't get to, I'll make a point of putting them in the mailbag. We'll do a mailbag episode on Friday of this week. Again, I've had some really good response to some of those mailbag episodes, and I appreciate it. Credit spreads have not been this low since July of 2007. What do you think about that? Thanks so much for the question, by the way. There are a couple different ways to look at credit spreads. I tend to look at it with high yield spreads, although, there are a couple different, there's an argument to be made for a couple different things, but credit spreads are basically looking at, how expensive bonds are and sort of the risks that bond investors are pricing into those markets. And why this is interesting is because these are the loans that bond issuers are having to repay, right? They're paying interest payments on their or coupon payments on the loan you're giving them, and other investors are giving them in the form of a bond issuance. And the question is, how likely are they to meet their debt obligation? How likely are they to meet their responsibilities and pay off debt that's coming due and all of that? With the high yield option adjusted spread, which is the series that we're looking here, it's one of the lowest levels that we've seen. And it could be a couple things. All right. One could be the bond markets, bond investors are pricing in fairly low risk and are basically saying conditions are pretty good. Another part of that, though, and what's hard is to just derive from this particular indicator what it really represents. The other argument that I think could be at work here is that these high yield companies, particularly in this data series, as conditions have improved, as the markets have gone up, as companies overall are doing kind of well, the risky companies are just less risky because they're a more stable footing. And so high yield is just less risky. It's less junky than it was before, right? Junk bonds are less junky because the conditions are improving. And so maybe that's keeping spreads a little narrower artificially because just the companies are in better footing. It could be a mix of both of those. It's hard to really tell. But I would say this is an indicator I've used for years as a way of tracking what the bond market is seeing in terms of risk. And that's always been a really good measure because equity investors, generalizing big time here, equity investors tend to be way more focused on potential gain than potential risks. We love thinking about earnings growth and the possibility of these companies to do amazing things years down the road. Bond investors are way more focused on risk because they are concerned primarily as to if they buy a bond, how likely is it that the company is going to miss their payments, right? And that is something you have to price in. And that's how these spreads are kind of part of the calculation of these spreads or that risk. And so bond investors are way more focused on the risk side. So in my Fidelity days, I would love going to the high yield desk, going up to the fixed income desk in Merrimack, New Hampshire, and talking to those fund managers about what they were seeing because they were way focused on risk. So when things looked good, it's like, all right, what are we missing? Hey, bond investors, what are you seeing that we're not pricing in yet? And a lot of times the fixed income markets would lead the equity markets in some ways because the bond investors just recognize the risks way more quickly than equity investors did. For what it's worth, credit spreads just not too wide and basically suggesting kind of still kind of a risk on feel here. Last question that I got to wrap this show. Eric, you asked, isn't that a dark cloud cover? I'm thinking you're going back to the S&P chart that I was looking at. So no, it's not a dark cloud cover, but you're close. And I give you partial credit. I probably have to give you no credit on like a CMT exam because it's not the right answer, but I like where your head is at. So I give you partial credit as a generous professor teaching a technical analysis course, which I used to do. I love getting partial credit for it. Boy, you were really close, but that's not the way you describe it. A dark cloud cover would be this exact thing, but if the close was like up here. So as long as you open higher and close lower, but you don't go below the previous day's open, but you're at least 50% of the way through that first candle, that's called a dark cloud cover. If a dark cloud cover gets more ominous and we close below the previous day's open, that becomes a bearish engulfing pattern. A lot of candle patterns, by the way, are very similar. And if you analyze the different patterns, what they mean, you'll see how they're just different names of looking at different degrees of bullish and bearish sentiment. If we're at least halfway through, it's this. If we're over 100% of the way through, it's that. If it's an inside day instead of an outside day, it has a different name. All of those names are ways of referencing different dynamics in short-term sentiment. But the bearish engulfing pattern, which we're showing here, the dark cloud cover, which you asked about to a lesser degree, are ways of indicating an uptrend, a big up day, a big down day, which suggests a rotation in short-term sentiment, which often becomes reflected in a longer term or a multi-day move soon after. Thanks so much, guys, for asking about that and for all the questions that you threw at me today. I appreciate you joining me every weekday after the close for Chart This. And as a reminder, we broadcast every day after the close. We will not broadcast tomorrow on Wednesday. I'm going to be flying to Orlando for the Money Show. Please make a point at the conference. We'll look forward to seeing you, and I'll look forward to enjoying our time together in Orlando. For Market Misbehavior, I'm Dave Keller. Have a great one. And remember, it's always a good time to own good charts. Have a good night.